Let's talk about HIMX, a Taiwanese fabless semiconductor solutions provider, a company that has had 5 consecutive quarters of double-digit % revenue growth, a company that's coming in under $2 billion in market cap, sitting at about $10 a share, and it only has a forward EPS of about 4.5, which, if you follow semiconductors, that's ridiculous. Hey everybody, Walrus here from Walrus Street, bringing you a trade idea. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. It's been a couple weeks since I brought you one of these. The last one that I did tell you about was Lovesac. When I made the video, Lovesac was trading at about $50 a share, and right now it's trading at about $75 a share, a short 2 months later. So that video did pretty well, even though it got like no attention. I don't know why. It even had a cute little title. Here, I'm gonna drop the cute little title, and instead I'm just going to get straight to business. This is the HIMX website. They are driving for a better vision. Their products include display drivers, micro display products, electrically tunable focusing lenses, touch panel controllers, CMOS image sensors, wafer level optics, intelligent sensing, and other display rated semiconductor solutions. I know what some of those words mean, and this sounds real fancy. If we go to their August investor presentation, which is the most recent one they have up on their website. A couple things that I do want to point out for you guys. This is not some new up-and-coming company. They were founded in the 1990s. They IPO'd on the NASDAQ in March of 2006, and for the most part, they have toiled in obscurity since then. Shareholders right now, about 52.8% retail, hedge funds 13, mutual 1.6, institutional 8.5, insider 24%. The company has been doing a share buyback, and it still technically has a share buyback open right now for about $12 million, but there hasn't been any news of that lately. And the company does pay out a nice fat dividend of about 2.58%, which is kind of surprising for a company of its market cap. The partners all around the globe include some of the largest tech companies in America and abroad. We've got some Chinese companies, we've got some Korean companies here. You can find HIMX DDIC, display driver IC technologies, in smartphones, TVs, touchscreens, laptops, tablets, smartwatches, everything like that. They also have touch and display driver integration in different types of smartphones and larger size tablets and speakers, as well as autos like EV touch panels. They use wafer level optics and 3D sensing, and you can find them with keyless entry door codes, bodily sensors, facial recognition, 3D printers, that type of thing. They have HIMAX 3D smart sensing technologies in various IoT purposes around the home. And this is where it starts to get really cool. The LCOS micro displays, that's the liquid crystal on silicone. We also have this seen in a lot of the VR, AR glasses, that type of thing. Here's a list of their partners. Pick and choose, a lot of great companies in here. But this is what caught my eye in their presentation, in AR devices and in VR devices. I'm going to take a little break right now, and I want to talk about this week. Facebook announced that they were going to be renaming their company Meta. They were going to be looking into the Metaverse, which is going to be VR and AR interactivity. And the company's going to be dumping billions and billions and billions and tens of billions of dollars into this field of research, which is going to be further developing the field. Now, HIMX has already been working in this field for a really long time. They have a lot of connections, they have the technology, and they don't list Facebook as a partner yet. And I can't help but wonder if, as Facebook is getting into this field, if they're going to be partnering with HIMX. Now, that's just speculation for me, but even if that is speculation, after the Facebook announcement last week, you better believe people are going to be looking for companies to invest into that deal with that field. And they're going to look at HIMX, they're going to see the PE value, they're going to see how attractive the company is, and people are going to be starting to pile into this on association alone now that we know what Facebook is going to be doing with the Metaverse thing. That is speculation, but you can logically see the connection there. This is going to be a market complement. In economics, we talk about complements, companies that move up along with other companies. This is going to be a market complement to Facebook's shift into the Metaverse. Now let's take a quick look at some of the financials. We're one of the leading semiconductor companies in the world, and this graph might look a little scary to you until you realize that this $674 million in revenue is only for the first half of 2021. So this is probably going to double or something close to it, and we're going to be about $1.2 billion in revenue for this year by the end of the year. As far as units sold, 609. I'm not really sure 609 million, what this actually means for units, what they classify classify as units, but this is going to be showing kind of like flatline growth in the units sold, but their revenue is going to be much, much higher. This is where it gets crazy. Their revenue and gross margin are up 44.2% already this year. They're increasing not just in China, who's their largest trading partner, but also in the rest of the world. So if something happens with China and Taiwan, they have partners elsewhere. Their OPEX is up. Their operating expense ratio reduced from 19.9% in the first half of 2020 to 11.7% in the first half of 2021, reflecting our careful management over operating expenses. The company's EBITDA is higher than it's ever been. 2020 and the first half of 2021, they've had much higher gross margin, mainly derived from strong demand for their products. And this is a company that's not in trouble for cash. Their total assets are over $1 billion, total current liabilities of about $457 million, but their current cash and cash equivalents is going to be about $250 million. So their current cash and cash equivalents can cover about half of their debt, but most of that debt is long-term debt, so it doesn't really even matter. The company is fine from a cash perspective. This isn't a company that's going to be issuing shares to raise money. They're growing in a normal financially sound pattern. Let's take a look at the chart on Finviz. You can see we've actually been floating around the support of about $10. $10 seems to be a pretty strong historical support going all the way back to the beginning of February. All of the financial metrics on this company are astounding. 2.5% dividend. We've got a PE of 8.4%, forward PE of 4.5%, price to sales, price to book 1.5 and 3% respectively. That's insanely low. Their debt to equity is only 0.26. EPS this year is up 444.5%. Insider ownership 12.3, institutional 23.8. The float and the shares outstanding are not super high, and they still have $12 million in buybacks that they can put towards decreasing this a little bit. The percent shorted is actually kind of high, 16.52%. Short ratio of 7.3. All of the financials look good, but really it's this PE, this forward PE that gets me super excited. If we look at the forward PE of some competitors like Intel, the forward PE of Intel is 13. The forward PE of AMD is 36. The forward PE of Nvidia is 54.7. Himax is coming in looking like a really big bargain at a 4.5 PE in the semiconductor solutions field. Now, this is from their last earnings report. Now, one of the things that's been plaguing providers in the semiconductor area, especially fabless semiconductors that don't manufacture their own products, has been the supply chain interruption, the shortages in everything that they need for production, the backlog. But one of the things that Himax has done better than any other company is shore up their foundry position through long-term contracts. This is just from their last earnings report in August. If we search foundry and come down here, in view of the foundry shortage and growing demand, the company has entered into strategic agreements with foundry partners to cover both short-term and long-term needs. Likewise, the company is entering into strategic agreements with customers, including indirect end customers who wish to secure IC supplies. All such contractual arrangements will help boost Himax's future growth prospects and improve earnings visibility. Looking further ahead, Himax expects to also secure more capacity for 2022 as compared to 2021. They've secured both short-term and long-term contracts with their foundries, and this is going to ensure that they don't have any supply interruptions, taking advantage of the high demand for their products right now. If we take a look at the chart on Webull, we can see the same thing we saw on Finviz. A strong support right around $10 here, so we're just a bit above the strong support. The RSI is kind of in the middle, kind of just floating around. It's a little bit on the high end, but not super high. The MACD is trending upward, and with the increased volume, it's looking like we're pushing towards a breakout. If we go to the financial summary, this is just incredible. Look at the revenue growth every single quarter going backwards. Year on year is astounding. We've had 5 straight quarters of double-digit % revenue growth, and I'm not talking about the year-on-year growth. I mean 309 to 365. I mean 275 to 309. This is insane growth for the company, and it's not just revenue, it's the net income is increasing also. We doubled it up from Q4 to Q1. From Q1 to Q2, it went up another 40%. These are incredible gains for the net income. The balance sheet looks really, really healthy for the company. The debt is completely manageable here, and if we go down to the total equities, the company's been increasing in that area too. If we go to the cash flow, because that's always a worry with some smaller companies, even though this is almost a $2 billion market cap company, we can see that they actually are having a net increase in their cash and cash equivalents up to $67 million. So they're saving money, retaining money, paying out a dividend, growing in all pertinent financial metrics. There's nothing not to like here. This is one of those silly articles like 7 best stocks under $20. Now, there's been a lot of these released about this company since like July. high. But the only reason I'm bringing this up is that the company is expected to post $424.3 million in revenues in quarter 3. If we go back to their revenue statement from the last earnings report, it was $365.26 million. So going from 365 to 423, this is going to be another $60 million in revenue growth for the company quarter on quarter. All of the financial metrics look incredibly solid. They've secured their Foundry position, even though they're fabless. One of the dangers is losing your spot in the foundries. I'm not sure why the short interest is so high in this company at 16%, other than the fact that it's a Taiwanese company. The only thing I could think is that people are equating Taiwan with China. Repeat after me. Taiwan is not China. Problems in China do not necessarily affect Taiwan, and if anything were to happen to Taiwan, you better believe the United States and all of the other Pacific allies would be right there defending the country. This is a safe investment geopolitically, and I'm not sure why people are shorting this company as much as they are. I'm not going to be talking about any type of short squeeze. I don't really like that, but this has been gaining a lot of traction on Reddit, on StockTwits, on Twitter, on all of the financial social media over the last couple weeks. So there's going to be a lot of buying interest leading up to this earnings report. So how am I going to play this one? The implied volatility is very, very high, 74.5%. Historical is about 40%, so we're well above that. But seeing as the earnings report is coming up on Thursday, that makes sense for there to be an increased IV. If we go to Webull and take a look at the analyst recommendations, we have 4 analysts here, 2 buys, 1 strong buy, 1 hold, and the average price target for the company is $16.70. So my plan here is going to be to open up a small share position in the company, maybe 100 shares. I'm also going to be selling a couple of puts on the company at about the $10 level, around that 30 delta level, wherever that works out to be on Monday morning. And I'm going to collect the premium, and then I'm going to turn around and use some, not all, of the premium that I've collected for this to buy some out of the money calls, just some lottery tickets about 2 weeks out for the company. Just to clarify, if we take a look at the puts right now, and these numbers are going to be changing on Monday morning, depending on how high the stock goes, I'm either going to be selling these $10.50 or these $10 puts on the company after I buy my 100 share position. And this is going to require some collateral, and it puts me on the hook for a couple hundred more shares, depending on how many I decide to buy. But I'm going to be okay with owning the shares if it does fall below this point, because I am pretty bullish on this company. Now, I'm going to be using this premium at the same time to go ahead and go to the calls, and I'm going to be going out 12 days for the calls past the earnings report. And I'm going to be looking at buying some of these $11 calls here past the earnings report. Now, that's going to be pricing me in for a very short-term lottery ticket call option. And this is incredibly risky, but because I'm selling the puts, I'm going to be using that premium to buy the calls, and I'm going to be buying fewer calls than the puts that I sell. So effectively, I'm just going to be losing out on some premium here, and my upside is that the stock runs, and I have the put premium plus the value of the call contracts that go. The downside is I lose the money from the call option completely, and I use the remainder of the put premium to offset my losses as I'm assigned the shares on the puts that I sold. Either way, I'm okay with it because I think $10 is a very fair price for this company as it stands right now, and the upside is very, very high. In summary, the company is very undervalued with a forward PE of about 4.5. We've had consecutive quarters, 5 consecutive quarters of revenue and net income growth. The company's been lowering its operating expenses. The company's in the middle of a share buyback that's been ongoing, although we don't have many details about that. It has been growing in popularity on social media. There's a pretty high short interest in this, and we all know that short interest could mean something pops either from natural causes or from social media hype. And we have a very foundationally, fundamentally strong company in an area that's growing thanks to Facebook's entry into the metaverse. Hope you guys did enjoy the video. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please like the video, subscribe to the channel if you want to be alerted to all my content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you next time.